My name is Wes Sapp from Empirical Research Partners, and today we're going to go through the building blocks of quantitative stock selection. So starting here on slide two, these are kind of the topics that we're ultimately going to discuss. First, quantitative models. What is a quantitative stock selection model? Why do we want to design one? Where do we start? And then ultimately, we're going to spend some time on how fundamental analysts can leverage quantitative tools. We'll talk about factor formation. We'll describe what a factor ultimately is. What are some key factors that we can utilize when we're designing a quantitative modeling framework, and look at some of the popular ones that'll ultimately appear in a lot of the models that you interact with. We'll also talk about style and timing, right? So when we look at factor efficacy, ultimately we don't expect a factor to perform the same way across different sectors or across different regions or in different market environments. So we're going to look at some ways that we can ultimately shift gears and lean into some factors a bit more aggressively in certain periods, and lean out of them when we don't think they're as likely to ultimately work. We'll talk about that in the construct of our regime indicator, which looks at the style biases of the market on a growth versus value continuum. We'll also talk about, just as we go through the presentation, some of the best practices to use when it comes to quantitative stock selection. Quantitative modeling can be really, really useful on its own, but the way that a lot of folks will utilize quantitative models is in combination with fundamental stock analysis, and they kind of go hand in hand and complement each other in a really positive way. All right, so let's go to slide three here and talk about the building blocks of quantitative stock selection. So like I mentioned just a second ago, quant models are designed to ultimately assist fundamental analysts when they're kind of combining the overlay from a quantitative framework with their focus on modeling a stock over the next 3, 4, 5 years. This is how we'll spend most of our time talking about quantitative models, but they can also be something that's a little bit more short-term in nature, a little bit more technical oriented. So we do see a lot of quantitative trading models that are looking at more technical factors within the model. Those can be really useful as well. And we'll talk about some of the factors that go into those tools a little bit later, but we'll also talk a lot about fundamental factors that marry well with a fundamental analysis approach. So by design, of course, quantitative models are really, really data intensive. And ultimately, I'm going to talk about this a lot. The quality of the data matters tremendously. So it's kind of the old analogy of garbage in, garbage out. So if we don't have a good data set to ultimately start with, we're not going to end up getting really strong results when it comes to the output of our modeling framework. This data can be sourced from a lot of different providers. Ultimately, we rely a lot on proprietary databases here at Empirical that we've built over the decades, and that can help us just have a higher comfort level in the quality of the signal that we are generating. So factors we can see here are ultimately going to be built based off of company attributes. Those can be fundamental in nature, drawn from an income statement or a cash flow statement or a balance sheet, or it can be something that's more focused on price momentum, more focused on ultimately sentiment of security. So that is all going to be encapsulated when it comes to a quantitative modeling framework. So I mentioned before Empirical's kind of belief set when it comes to quantitative modeling. We see fundamental research and quantitative analysis as kind of inseparable when it comes to a stock selection process. The quantitative analysis that we conduct basically informs a lot of the portfolio strategy research that we do, and our clients generally use it as a jumping off point for their own fundamental analysis. We model thousands and thousands and thousands of stocks each and every day. And as a fundamental analyst, it's going to be really hard to ultimately be an expert on all of those companies. So what we see quantitative analysis doing quite a bit is to narrow the investable universe, try and put our clients into better stocked ponds so they can ultimately spend their time efficiently, focusing on stocks that have a higher likelihood of outperforming and really getting into the weeds on the 10, 15, 20 companies that they ultimately cover. So that is the way that we typically look for quantitative analysis to complement the fundamental research that our clients provide. The purpose of the quantitative model is to ultimately become a dispassionate odds-making device. We think in the long run, fundamentals will win out. So when we talk about the construct of our core stock selection model, we'll talk about how important the fundamentals ultimately are. But we're trying to build a framework here that allows us to ultimately take the good and the bad when it comes to modeling a security. We don't want to get too entranced with a company's story and ignore the fundamentals. We don't want really get excited about the growth of a company and ignore the valuation. It's all about kind of trade-offs ultimately when it comes to a stock's attractiveness within a modeling framework. So when we look at why design a quantitative stock selection model, I started to talk about it a little bit, but it's an odds making device, and it's a way of ultimately comparing companies on a like for like basis. So we're going to combine factors in an engineering environment to provide a structure in which you can compare companies. There are no two companies that are exactly the same. No two companies have the same story at the end of the day. Even if you look at companies as similar as say a Visa and a MasterCard, very similar business models. But if you look at the underlying attributes of the company, one's going to be a little cheaper than the other. One's going to have maybe higher margins. One's going to have a better growth story. So ultimately, a quantitative model gives you a framework for comparing those two companies. Sometimes it's going to pay to bet on growth, but what is that difference level? Does a 5% EPS growth rate matter? Is that huge? Is that small? Are you willing to pay a 5, 10, 15% premium for that growth rate? The quantitative model ultimately gives you a structure on how to compare these two stocks. And like I said, there's always going to be some blemishes when it comes to a stock's attributes, right? There's no stock that looks amazing on each and every factor within a modeling framework. And if it does, the model might come into question there because a cheap stock is going to maybe be cheap for a reason, but there's going to be an inflection point that helps to ultimately unlock that value. There is going to be a certain level where the momentum trade gets just too far, right? There's going to be a situation where the valuation can no longer support the price where the stock is trading at. You want some conflicting signals ultimately when building our model, just so you're not making a one-way bet. And like I alluded to before, like the reason why we want to do this stock selection modeling framework is ultimately to help you make decisions about the attractiveness of a stock before you actually have to push the button, right? When you're making a buy or sell decision, that's too late to incorporate the framework. We want you to ultimately be able to incorporate this in your kind of your day-to-day life and use it in a systematic way to help you kind of understand which stocks are more attractive and which stocks are less attractive within a particular universe. All right, so just showing a little bit about how quantitative models can provide value. This is a look at the live performance of a suite of our models here at Empirical Research Partners. So we actually date the live performance of our modeling frameworks back over 3 decades now at this point in time. And you can see the gray bars here show the outperformance for stocks that are in the most attractive quintile of our model. The black bars here show the underperformance for stocks that are in the least attractive quintiles of our model. So our US model, which again has a 30 plus year live track record now, has generated over 6 percentage points of alpha per year since its inception. The black bar here shows the worst quintile underperforming by about 4 percentage points per year. So we're looking at over a 10 percentage point best worst quintile spread. So this is a really strong starting off point ultimately for our clients. And the way that we articulate the benefit of the stock selection models, well, we've pushed you in this direction. And we think ultimately you can do better than what we've achieved when it comes to the model's track record because you're overlaying your fundamental analysis on top of that. And if you can see some of the blind spots that might exist within the quantitative model, maybe you do even better than the 6+% that we're seeing when it comes to outperformance. Or maybe you're able to avoid some more of the blowups when it comes to stocks that are ultimately in the worst quintile. So the models work great on their own. They have a long, consistent track record of alpha generation, but they can do much better when we start to look at fundamental overlays as well. All right, so where to start when it comes to modeling or building a quantitative modeling framework? And as I mentioned, quality data, 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 data. So what we talked about here at the top of the slide is that ultimately Empirical has utilized scores of different data vendors over the last 30 years of our quantitative modeling effort. We have a large number of research providers or data providers that look at fundamental data. We have providers that help us look for non-traditional sources like big data factors. We have providers that look at sentiment, look at short pressure. Ultimately, a large amount of data is ultimately the best starting point when it comes to developing a quantitative modeling framework. We've made a lot of effort in ultimately cleaning the data set. So we will use multiple vendors to ultimately fill in any kind of gaps that we see to build a data set for our models. In the US, at least, they go back into the early 1950s for most of our variables. Outside of the US, we use data that goes back to the late 1980s. And that starting off point allows us to do a rigorous analysis of factor efficacy and have faith in the results, right? We can go in and back test a variable over a 70-year period that not only looks at the efficacy over the entire time period, it can look at the efficacy over various market cycles, right? If we just use a back test based off of data that might be readily available for Bloomberg with a particular factor, and we're focusing on the last 5 years, the efficacy might be wildly different over the last 5 years compared to what we might see if we have a longer look back period. It doesn't have to be 70 years, but 10, 15, 20 years are probably going to be the minimum that you ultimately want when it comes to analyzing a factor's efficacy, just so you get a sense of how it's going to respond in different environments. Again, if you just focus on the last 5 years, maybe you were in a huge growth rally and all of the growth metrics look amazing and it looks like value can't generate any alpha. Well, you're going to get a very different picture if you look back over, the period around the financial crisis when value stocks did incredibly well coming out of the financial crisis beginning in March of 2009. I mentioned big data already, but that's one of the topics that has come up quite a bit when it comes to developing quantitative models over the last few years. So these non-traditional sources of data, we use sentiment data, we have used sector ETF flow data in the past, various ownership data metrics. We utilize some different measures for different positions within our modeling framework. And we've now even incorporated some more AI-driven data that is derived from ChatGPT. So this is probably a little bit more of the next frontier when it comes to quantitative modeling. And our machine learning efforts certainly fall into that same grouping, where it's maybe a little bit of a non-traditional way of piecing together models, but it has shown really good performance for us over the last 4 years or so when it comes to the machine learning superfactors that we built into our modeling frameworks. All right, so like I mentioned, big data and machine learning are things that ultimately can be really useful within the models. What we have found the most efficacy with when it comes to those tools is actually using them in combination with fundamental factors. So if we see a stock that is cheap and it has high short pressure being one of the big data factors that we ultimately look at, that can give us a good sense that the stock is cheap for a reason, right? There's a lot of people still out there betting on the stock. And now, if we see a similar combination, but looking for stocks that have cheap valuations, that have really positive sentiment, that can be a really good signal that this is ultimately a stock that's going to inflect and start to outperform. So when we look at these big data factors, when we use machine learning, we generally look at them in the context of fundamental factors, just to give us a sense that ultimately these fundamental factors are going to be the ones that deliver alpha over substantial periods of time, investment time horizons. So if we find a quality company where we can use big data as a kicker, where we can use those ChatGPT derived factors that I mentioned before as a kicker, that's what we think at this moment, at least, is an ideal use for these less traditional metrics. And that's just an example of how engineering can become really important. We don't want to add complexity for complexity's sake when we build our models. We don't want to throw every factor that we can think of into the tool. We ultimately want to build a model that is worth more than its individual parts, right? We want to have complementary pieces of the model, like I mentioned with valuation and sentiment, where you are getting some additional bang for your buck with the inclusion of these new metrics. And like I mentioned, when it comes to the long history, ultimately the models that we've constructed here at Empirical is based off of decades and decades worth of history, right? We're tailoring our modeling frameworks not just across the overall universe that we're looking at. We're looking at it based off of sector. We're looking at it based off of region. As I mentioned before, we're looking at it based off of the style bias that we see within the model. So it is an ever evolving science when it comes to developing a quantitative framework. All right, so looking at factors. So what is a factor? A factor is really just a measurable variable that allows us to rank a stock. You know, it can be something really traditional, like a price to book value or a price to earnings value, or it can be something that like I mentioned, less traditional, like a sentiment signal that's using a natural language process. Useful factors are variables that we can actually tie to some kind of result within the stock. There's a lot of factors out there that are interesting, but they might not actually have any kind of predictive power when it comes to whether or not a stock is going to outperform or underperform. So when we're looking at back tests, we're looking for that efficacy, and we're generally biased towards factors that are going to work with a good batting average, right? We don't necessarily want to look for a factor that's only going to work 1% of the time, but when it does, it works really, really well. That's just setting us up for a lot of disappointment. We ultimately want to have factors that we can rely on that will give us a consistent signal that delivers alpha. We also have a bias towards factors that are monotonic in nature. So if having really high free cash flow margins is great, we want to make sure that having low free cash flow margins is bad and having average free cash flow margins is just middling. That helps to provide an expected return that has efficacy across the range, right? It's not just useful in identifying stocks that are poised to outperform. It can also be useful in identifying which stocks are expected to kind of tread water. This allows us to have a view on each and every stock ultimately within the universe. All right, so looking at specific examples of some factors. So this is a listing of style factors, and anybody that's has some experience with Fama French modeling will recognize some of these metrics. So kind of broad brushstrokes, some of the factor examples can be attributed to the value of a company. This is typically looking at things like price or enterprise value to a company's earnings, a company's book value, a company's cash flows. All of these are kind of traditional fundamental measures. When we're looking at momentum, this tends to rely on price momentum. So price momentum can be measured over various periods of time, looking as short as a couple of months to all the way out to a year or even further. Momentum tends to be a strong performing signal that is maybe a little bit more short-term focused than some of these other quality or value metrics that we ultimately see. With quality, this is looking at those strong balance sheets or those great income statements or cash flow statements, right? A company that has really stable earnings growth can be particularly attractive in various times of a market cycle, right? When people are afraid that we're going to enter in a recession, having stable earnings growth is something that ends up delivering a considerable amount of alpha. Having high profitability, however you measure that, whether it's return on equity, return on assets, return on invested capital, or something like free cash flow margins or gross cash flow margins, are positive attributes within a modeling framework when it comes to the health of the company's just business. We also look at low volatility, so it's looking for securities that ultimately have just lower price volatility compared to the market. This might tie in a little bit with stable earnings growth, but you're looking for less risky stocks at the end of the day. So maybe they have lower peaks, but they also ultimately have higher valleys, so that risk-adjusted performance can be better for low volatility stocks. And then for growth, you can look at things like earnings growth. You can look at top line growth. You're looking for a company that is being successful and ultimately expanding their business. And then finally, size can also be a factor. So smaller companies tend to have higher growth potential, but also higher risk depending on the period of time. You'll see a bias between small cap companies and large cap companies. If we look at a really long period, small cap companies have tended to outperform. If you probably focus more on the last 5 years or the last 10 years, large cap companies have typically had the advantage. Style factors and fundamental factors, individual stock factors are really not the only things that you can consider when it comes to building a quantitative model. Here's just a handful of macro variables that also could be useful, looking at things like interest rates, inflation, the economic landscape. These tend to be useful when it comes to identifying an advantage that a stock might ultimately have compared to their peers or compared to their broader universe. So if you see an exporter and they are ultimately operating in an environment of a declining exchange rate, that can be a really great sign for them, right? That can be something that helps to propel the stock's share price higher because all of a sudden they're going to benefit from cheaper exports. When it comes to talking about interest rates, there's definitely going to be stocks that benefit from a steeper term premium, right? So think about your financial institutions might be in a situation where that's beneficial. So these macro variables can be used kind of as an overlay, whether that's helping to identify specific stocks or specific sectors that might benefit from the current macro environment. So we can also talk a little bit about market reaction. So this is stepping a little bit away from the fundamentals, but it's kind of looking at how investors are responding to those fundamentals. We already mentioned price trends, and that's a really useful signal. It's been a great performing factor so far in 2024. But other kind of measures of market reaction are looking at things like short pressure, which I mentioned before, which for us is a utilization calculation that looks at the amount of stock that is being sold short, scaled by what is available to short. We also look at technical indicators. These can be really short-term in nature and look at things like MACD, Bollinger Bands, those types of metrics to get a signal on whether or not a company is overbought or oversold in the short term. And then sentiment, which I've mentioned before, is something that we've incorporated in our models for 7, 8 years now at this point in time. And it just gets a read on whether or not the company is enjoying positive news stories or positive earnings announcements. So we in particular look at headline sentiment, we look at news story sentiment, and we look at earnings sentiment, and we kind of aggregate that up into a single sentiment signal that again we use as a signal that we can kind of catalyze some attractive characteristics, right? So if we think the stock is cheap and it's got strong sentiment, that's a good signal for us. If we think the stock is expensive and the sentiment has soured, that's ultimately a situation where we would want to avoid that company because we think underperformance is on the horizon. So taking a look at some of the factors that we think ultimately matter. When it comes to focusing on fundamentals, we do think management decisions are really central to long run value. Again, less of a trading signal whether or not a stock is going to outperform over the next day or the next week or the next month. But if we look at companies that are making smart decisions when it comes to their deployment of capital, that's something that we think accrues alpha over a multi-year time horizon. So if we see somebody that is managing the company in a responsible way, maybe they're trying to run a capital light organization where their capital expenditures are in line with the rest of the sector or below the rest of the sector, that's something that we've seen add value over time. We also consider things like share repurchases or dividend growth to ultimately be management decisions. Returning that capital to shareholders is ultimately something that we see as generating alpha over time. And then investor behaviors, again, we think these have predictable consequences. So we do sometimes lump valuation into investor behaviors because, again, they're kind of responding to the earnings of a company or the cash flows of a company. We think valuation can be crucial, but as we kind of will walk through a little bit later in the deck, the way that we apply valuation is going to vary by sector. It's going to vary by industry. It's also going to vary depending on where we are within the cycle. And then also investor investor behavior. Again, talking about the current stock price of the company. That's important when it comes to kind of generating kind of price momentum signals and those types of measures, which we mentioned in the context of market reaction. And then big data, machine learning. Again, this is something that we think is complementary to everything else that we look at when it comes to our modeling framework. And with machine learning, what we've really focused in on is trying to understand the primary trend at work within the market. So with machine learning, the idea is that ultimately we can construct a model that is based off of our worldview, where fundamentals are important, where valuations are important, but machine learning can help us to identify what the market is actually focusing on at a given point in time. So if we think about kind of the early stages of the pandemic, right, the market was really focused on these companies that could grow through this headwind, right? It made the stocks like the Pelotons of the world really, really exciting for investors. Machine learning can pick up on that characteristic and ultimately, at least around the edges, change the way that we define attractiveness by looking for those growthier stocks that might not have the fundamentals in place. It can identify that when that's the trend in the market. At other periods of time, the trend might be more focused on value. It might be more focused on earnings revisions. Machine learning adds additional flexibility into a modeling framework. All right, so what factors matter? Just kind of looking at creating and identifying factors. This is something, again, like I mentioned before, it's an ever-evolving process. If we were to utilize the same models that Empirical started off with back in 1992, they wouldn't have the same efficacy, right? The market has adapted, the market has changed. Some of that efficacy can ultimately be altered by, accounting changes, or it can be altered by regulatory changes. We've talked a lot about earnings revisions over the years being impacted by the changes that were brought on by Reg FD. So ultimately, you have to be cognizant of the fact that the efficacy of your factors can just be altered, right? You can see factors where the efficacy has diminished ultimately over time. So that's something that requires you to stay on top of your modeling efforts. As I mentioned before, we also believe factor efficacy can vary depending on the sector or the industry or even the region that we're looking at. Free cash flow metrics, as an example, might be much more important in the US than they are in Europe or in Japan. You can see differences there based off of the way that people look at those economies, but also the way that those regions are constructed. If you have a region where there's a lot more tech and healthcare, maybe that lends itself more to cash flow metrics. If you have a region, maybe like the emerging markets that has a lot of banks, you're going to ultimately be looking for different factors there. And then, like we mentioned before, the combination of factors can be complementary, right? So looking at valuation with sentiment or looking for good price momentum with low volatility. What we're looking for with the combination factors that we use is a stronger signal. We want them to be better than the individual parts, but it's not a situation where every combination is ultimately going to be useful. And you need to be careful when you're looking at some of these signals to make sure that you're not really double counting, right? So if we combine two valuation metrics, that might look better than using one of those individual valuation metrics on its own. But how correlated are those results? You're kind of just really looking at two sides of the same coin. And then ultimately, the objective of the modeling framework should be identifying an alpha signal. So at Empirical, we talk about the expected returns of our model, and we can rank order every single stock within the universe based off of this expected return, from the stocks that we think are most likely to outperform all the way down to the ones that we think are most likely to underperform. And so that end output needs to be something that is able to be consumed by the investors that are ultimately making the decision, right? That there needs to be some way of translating the expected return, in our case, into a signal that portfolio managers or the investors can ultimately carve through to get a sense of which stocks are most attractive or least attractive within their particular buying universe. So we talked a little bit about the empirical models, and we've shown you the performance. These are the five super factors that we have ultimately constructed when it comes to judging the attractiveness of stocks, and we really deploy this kind of across the board. The construct might be a little bit different depending on the universe that we're operating in, whether it's a U.S. versus developed markets, ex-U.S. versus the emerging markets. But these are the five frameworks that we rely on: valuation, capital deployment, and earnings quality. We also look at market reaction and machine learning. So valuation, we believe over the long run, value approaches do prove effective. We can walk through the value construction in a different conversation, but ultimately we rely on a pretty broad set of valuation metrics. We have 17 different valuation metrics that we utilize. It includes some traditional metrics like price to earnings or price to book values, but we also have things that are maybe a little less utilized, like a total yield calculation that looks at dividends plus the return of capital to shareholders via share repurchases. We look at R&D stock to enterprise value, which is something we found to be particularly useful when it comes to growthier sectors where we're giving them credit for their R&D expenditures. We're treating it like an asset and ultimately looking at valuations based off of that. And then also cash flow metrics, which is a really critical part of what we do at Empirical when it comes to our valuation constructs. For capital deployment, we talked about this is when decision making of a company ultimately comes into play. We focus a lot on capital spending decisions. We focus a lot on return of capital to shareholders, but we'll also analyze things like the M&A of a company, the changes in inventories for a particular company. So valuation and capital deployment tend to be a little bit more contrarian when it comes to their signal value. We're looking for companies that are kind of battening down the hatches. We're looking for companies that are going to have turnaround when it comes to cheap valuations. That's our view there. Earnings quality tends to be a little bit more growth oriented. And so quality, I mentioned some of the factors that you can utilize when it comes to quality before, but it is probably the most subjective of the super factors that we build because quality is very much in the eye of the beholder. What's probably the most common quality metric that we talk about with our clients is return on invested capital. That seems to be really popular. But at Empirical, we rely really heavily on free cash flow margins. And we've seen more and more companies that our clients adopt that metric when it comes to judging quality. But we look at the free cash flow margins of a stock. We look at some interaction variables with looking at its sustainability or looking at its growth rate. Those are all things that ultimately can be beneficial when it comes to judging a stock's quality. And so moving away from the fundamental factors, kind of the more momentum-oriented factors, market reaction, which we talked about, a lot of price momentum there. We look at the price momentum in certain contexts, right? Having great price momentum on its own is really positive, and we tend to rely on 9-month price momentum as our signal. But again, the look back period can range depending on your intent when it comes to constructing the model. But we like to marry price momentum with signals that make momentum more likely to carry on in the future. Like we look at the return skewness for the stock in combination with price momentum. So we would much rather have a stock that is outperforming by a little bit each and every day within our portfolios, as opposed to the stock whose price momentum might look great because it's up by 30% in a single day and it just doesn't do anything else. The former is much more likely to repeat in the future. And so if we're worried about the batting average, we want to ultimately find those factors that are going to deliver the consistent outperformance. Market reaction is also where we include those big data metrics, like we mentioned sentiment before, short pressure. That's the house for those. And then machine learning. We've talked a little bit about machine learning, but the way that we've constructed machine learning is to really complement the rest of the modeling framework. We've built a factor library that includes every single factor that we consider when it comes to the prior four super factors: valuation, capital deployment, earnings quality, and market reaction. We've developed a framework that helps us analyze which of those metrics is ultimately going to have the highest expected returns. So we've done it in a way that creates kind of a slow moving character with an emphasis on fundamental data. Your objective might be wildly different, right? Maybe you're looking for more of a trading signal. You can change the look back period. You can change the factors you're included. You can and change the actual machine learning algorithm that you ultimately utilize. Again, machine learning has a lot of potential. We've seen really good results for it in live performance over the last 4 years, but it is something where your creativity in constructing models can go wild. All right. So as I kind of mentioned, some of the super factors here are ultimately a little bit more contrarian nature, and some of them are a little bit more growth or momentum oriented in nature. So when we build our models, it's pretty balanced between the two. We show the contrarian items that are off here to the right, valuation, capital deployment, the more growthy, momentum oriented factors here on the left. When we are judging the attractiveness of stocks, we make a judgment based off of kind of two considerations, at least in the US. We'll compare every stock versus the universe, and then we compare every stock versus its sector peers. So there is actually a lot of engineering effort that goes into building our modeling framework because it's not one simple modeling framework. Maybe that's where you choose to stop, and that can be completely fine. But we've seen a usefulness in ultimately looking at those interest sector comparisons. So we will judge a stock not just versus its universe peers, we'll also judge it versus its sector peers. And we define sectors in a more granular way than what you would see through GICS. We actually have 22 different sectors that we utilize. So we're not going to treat a semiconductor stock the same way that we're going to treat a staples company. We're going to go in and change the way that we view valuation depending on the sector that we're looking at, to change the way that we view quality in the sector that we're ultimately looking at. And so we want to kind of blend those two together for that single expected return to find stocks that we think are going to outperform at a given point in time. And the weights here are also not really set in stone, right? We want to be able to dynamically weight our model depending on the environment that we see ourselves operating in. So I mentioned earlier that we do think factors can see different efficacy depending on the style that we're operating in the market, right? Just whether or not you had a guess, right? Do you think value factors are ultimately going to work when growth is in favor? No, no, not really. Some might perform well, but you're certainly not going to see the same amount of alpha as you would if we're in a value-led market, right? Again, I mentioned the financial crisis as an example coming out of that second half of 2016, after the vaccines were announced in 2020. Those are periods of time when values really going to shine. So we build dynamically weighted models in order to be able to take advantage of those opportunities when they do present themselves. And so when you're constructing these models, again, we want to make sure that everything adds value. Otherwise, it doesn't really have a place in the tool. So this is the super factor performance of our models. And you can see valuation adds value, capital deployment adds value, earnings quality, market reaction. But because we do have different expectations depending on where we are in the market environment, we don't expect all of these super factors to be firing on all cylinders at once. We want to be able to pull the levers behind the scenes to take advantage of those situations where value is likely to outperform. Or we want to be in a situation where we want to ride the wave. When market reaction is doing really well, maybe we lean more into that factor. But at the end of the day, you want the sum to be worth more than the individual parts. And that goes down to the engineering in addition to that dynamic factor weighting. So just to give you an example, ultimately, of how factor efficacy can change over time, the chart here off to the right on the deck looks at the returns of cheap stocks versus stocks that score well in our market reaction super factor, again, which has got a lot of price momentum in it, depending on the regime setting that we're operating in. And so you can see the 5 settings of regime down at the bottom of the chart here. So we look at value-driven settings, we look at value-tilted settings, neutral settings, growth-tilted, and growth-driven. So in value-driven, value-tilted settings, you see really strong performance for stocks that are cheap, right? It's telling us that the regime indicator is pushing us in the right direction. In value-driven settings, in live performance for us back to October of 2007 for our regime indicator, you generated almost 250 basis points of alpha per month on average by betting on cheap stocks. In value-tilted settings, you still are adding a pretty decent amount of alpha, 60, 70 basis points of alpha per month in those value-tilted settings. But then as we shift into a growthier environment, value starts to struggle. Market reaction has the opposite return profile, right? Value-driven settings, market reaction underperforms, kind of treads water in value-tilted settings. And then we see the performance and the alpha generated by these best quintile market reaction stocks improve as we get further and further into a growth-driven dynamic. So knowing when to pull these levers and being able to benefit from value when it's most likely to work and being able to benefit by betting on trends when they're most likely to work is a great way of ultimately enhancing the efficacy of a quantitative modeling framework. And so this is how we construct our regime indicator. And so what makes our regime indicator a little bit different is we do rely a lot on rolled up stock level data. So our US regime indicator focuses on things like the level and direction of valuation spreads in the market, right? So if we see a really big dispersion between cheap stocks and the market average, that's been a really tremendous signal for us that valuation is going to outperform over the next 12 months, over the next 24 months. So if we're in a situation where there are wide valuation spreads, that's ultimately going to push us more into a value-oriented regime. We also look at the expected returns of growth stocks versus value stocks within our modeling framework. If growth stocks are super attractive within our models, that's a really good signal that growth is going to lead the market. We look at some return dynamics factors. If we're in a really strong momentum-led market, that's ultimately more of a growth attribute. If we see investors penalizing companies that have high asset growth, that's going to be more of a value oriented signal. We also look at the returns to free cash flow margins. If those are really in favor, investors are focusing on those, that's another really strong growth signal for us. We also look at the correlation of top line growth and fundamental stability. When those two metrics are kind of working in unison, that tends to be at the tail end of a market cycle because you have some people that are still betting on growth to continue, and you have some people that are kind of putting on their helmets and ready for the market to roll over. That's a signal that we found to be really useful. And we do have a couple of fixed income factors in here as well, looking at the shape of yield curves and analyzing credit spreads. And so the last couple of charts that we're going to talk about in this section look a little bit about finding failure. So within our stock selection model process, with the core model that I mentioned before, I mentioned having basically monotonic returns. So identifying stocks that are attractive, that are likely to outperform, but also having a signal for stocks that are likely to tread water or a signal for stocks that are likely to underperform. At Empirical, we also have a failure framework that has a really great track record. It's been around for about 20 years now at this point, and I'll show you the performance here in a slide or two. But we found that quantitative tools can be particularly good at identifying failure because stocks can outperform for a lot of reasons, right? They can have a popular new product, they can have great management, they can be cheap at the right time, they can be part of a strong sector rotation where, you know, NVIDIA chases or pulls everybody in the semiconductor sector higher, right? That can all be a signal for outperformance. But what we found is that stocks underperform for very few reasons, right? They blow up, and that consistency there tends to be consistent across the different stocks that we're looking at. So the characteristics that we look for are basically stocks that are expensive, stocks where we see signs of management overconfidence, and then some sign that investor doubt is ultimately starting to creep into the equation. And so you can see the returns here for the failure models that we've been running for about 20 years now. In the US large cap space, we've generated about 10.5 percentage points of alpha per year since inception. The small cap version is closer to 12.7%. The returns over the last year, 3 years, 5 years have been really extraordinary. This has been a really powerful tool for different segments of our business, right? We have some hedge fund clients that ultimately will use this as idea generation within their short book. So just like the most attractive quintile of our core model can be idea generation for a long-only portfolio manager, the shorts within the market really like the output of the failure model for that purpose. We do have long-only clients that utilize the failure model, but they tend to use it as a risk management signal. So if they have one or two failure candidates within their portfolio, maybe that's not the end of the world. But if you have 6, 7, 8 failure candidates, statistically, the odds start to be stacked against you that all of those companies are going to outperform. And so it might make sense to go in and trim some of those exposures. We even have clients that have utilized our failure model as part of an enhanced index strategy, where they will take a broad index like the Russell 1000, they'll avoid the failure candidates, and then ultimately reinvest the proceeds in stocks that are more attractive within our modeling framework. So it's a really flexible tool that's become really popular with our client base over the last 20 years. So this can also be a great way of ultimately kind of focusing your quantitative efforts and at least avoiding blowups when it comes to stocks that are in your buying universe or more directly in the portfolio. The Failure model has also done really well across sectors. We don't sector neutralize our failure model as much as we do in the core model. We don't make those two comparisons that I talked about before. Ultimately, comparisons that we make are across the universe, so we can focus on where the risk is in the market at a given point in time. So you are more likely to see, a tech company, a healthcare company, consumer discretionary appearing on the list compared to like a Staples or utilities. But in the 20 years that we've been modeling stocks, we've generated alpha on a sector relative basis across the board. And then just looking at the construction here, we'll go into all the details of the factors that we've utilized. But again, these are some good examples of metrics that might be useful in your own quantitative tools. But we look at those three criteria primarily. We look at the valuation of the company, which is up here in the upper right-hand corner. We look at the management behavior surrounding the stock, looking for signs of overconfidence. A company that thinks that they are going to enter into a great new business and their capital spending growth goes to the roof and their inventory goes to the roof, and then they have to figure out a way for paying for all that. Those management behavior factors are illustrated here in the bottom right. That points us to a lot of kind of growthier stocks at the end of the day. And that's not what we always want to bet against. So what becomes really important is looking at these market reaction, market structure factors off here to the left that help us with those timing considerations, right? We don't want to bet against companies when everybody in the room thinks the stock is ultimately going to double. We want to take advantage of controversy. We want to bet against these companies when half the people in the room think the stock is going to double, and then half the people in the room think ultimately that the stock is going to go to zero. So that's what we wanted to cover in the first section, in incorporating quantitative models. So I appreciate you guys taking the time to review the framework, and happy to answer any questions as they come up.